We are rolling. Episode 14 of the Capital Spotlight podcast, hosted by your boy, Craig McGrother, alongside the co-founder and principal of Lone Star Capital, Rob Beardsley. How are you today?
I'm good. We're in LA, which is why we're wearing glasses inside.
All right, I can't go any further than that. We wanted to keep it fun and lighthearted here. But yes, we are in the Mondrian in West Hollywood right now for a fun event that you will be speaking at. So we'll be doing a lot of networking when we're out here. It's really, business and pleasure always overlaps, especially when we go on a lot of these trips. But we thought it was going to be more pleasure, and then ended up being actually probably more business because we've got our team out here. We've got Weston who's going to be here, and then we're going to meet up with our good friend, our partner, our mentor, someone who just looks after us in our business, Hunter Thompson, tomorrow. So he'll be on the show the following week, which we're really excited about that. And then we'll also be seeing him in New Orleans for his event there. So no rest for the wicked on this trip, but we are in the Mondrian in West Hollywood, and you have some history here. Do you want to break into maybe your experience coming out to LA? Because we're obviously from the Bay Area, so going to LA was something we did a lot. And then obviously just as a city and at Los Angeles, kind of interesting because we're growing up, it's like, oh, the Bay Area, LA, blah, 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 and there's always like a little bit of beef regarding it. For those who are familiar with California, I'm sure if you're from various places throughout the nation, there's little stuff like that as well. But it's very definitive how much cooler Los Angeles is in the Bay Area. Wouldn't want to live in either place anymore, but if I had to live in one, LA is a lot sweeter, better weather. But why don't you kind of tell us about your experience, this hotel, kind of the Hollywood scene, and then just Los Angeles. And have you ever lived here actually? And maybe kind of unpack that part of your life.
First of all, we're very lucky that we're not famous because you're just doxing us all over the place. Oh,
right.
We're at this hotel.
Well, there's a week later, yeah. It'll come out in a week, yeah.
No, it's fine. I'm just kidding. But yeah, this is my go-to hotel when I come to LA. Not because it's the nicest or it's just a good location, very straightforward. And I don't like to rent a car when I'm in LA. That's kind of a lesson that I've learned. I have lived here for a little bit, lived in Santa Monica. And if you wanted to go and meet a friend, not by the beach, but in the city to go work out or meet for lunch, it could be an hour drive. So anyway, I'm already starting to complain about the LA traffic, and we're not even really done anything yet. So anyway, we're here. We have a lot of familiarity. This is kind of back where we're from a little bit. So we're on the West Coast. I'm already missing New York, taking back to the city.
I'm already missing Scottsdale too. It's sickening, but I love it there, and it's funny. I'm going to be gone for a month coming up, which you think is nothing, no amount of time. But for myself, that is quite a long stint to be gone for. So I already miss it as well. So it's kind of funny.
Well, what do you have for us today?
Yeah, so we have a really fun and stacked agenda. We've been meaning to get to this topic for a little bit of time, but it is the year anniversary of the drop of Rob's second book, Structuring Debt and Equity for Multifamily Acquisitions. And then, as on last show that was discussed, you and Brad were just in Texas, in Houston and San Antonio. So love some updates on those two places and just a walkthrough for what you look for when you're touring a new city from your lens, from the real estate perspective when you're making acquisitions, the do's, the don'ts. I think for many people who are looking to maybe buy deals themselves or to invest or raise money for it, I think your perspective is very, very unique and should be heard. So we would love to hear your thoughts on that. And then another fun topic, we'll have a mailbag question or two. And then finally, a new business announcement with the watch business. And we actually have our first piece that we've sold to my good friend Zach in Arizona, Zach Wiles. So shout out to you, and we'll go through that piece. It's a gorgeous, gorgeous watch. You got obviously an excellent price.
Don't spoil it.
I'm not going to say the name yet. I wouldn't do that. But yeah, so fun show here. And then once again, if you ever have any questions you want to get answered on the show, please email us at mailbag. Is it mailbag?
Mailbag, info, IR.
Yeah, mailbag at lscre.com or ir@lscre.com or my email, craig@lscre.com. And then finally, I'm going to keep saying this until the event happens. The Lone Star Capital Summit is coming up October 16th and 17th at the One World Trade Center, which is where our office space is, for maybe even a promo code. Why don't we give a 25% off code while we're here? If you want that code, email me. I know you and Dasha are mad because I took money out of your guys' pockets, but it's okay. Email me. Our listeners deserve it. Email me at, once again, craig@lscre.com. We would love to see you there. It's going to be a great event. And then finally, if you're looking to raise equity for any deals, you're looking to make an investment or learn more about Lone Star Capital, generally, of course, reach out to me for hopefully the final time I'll say my email on the show, craig@lscre.com. Okay, let's get into the meat and potatoes of the show, which is to start, and this is something I wanted to talk about on your end because you wrote the book, obviously, and this is the second book you wrote, which is a look back at 1 year from structuring debt and equity for multifamily acquisitions. So I remember you had had a lot of it maybe blueprinted, but hadn't gone pen to paper on it. And then we were in Positano. There's some nicknames for that city. We won't get into them, but we were in Positano. And I think you felt a little bit guilty about that process. And then like that, your brain really started firing. And 2 weeks later, I think the book was was finished and then edited and then released at our Summit event, which is about actually a year ago on the dot. So maybe just retrospectively walk us through the inspiration behind the book, maybe what it's brought you, what you've learned from it, and everything like that.
So I really look at the second book as a sequel to the first book. And so my first book was about multifamily underwriting. And underwriting, for those that aren't familiar, we actually covered it a couple weeks ago on the show, but it's the analysis, the financial analysis of acquisitions. And if you learn how to crunch the numbers and all that, that's all well and good, but I always thought, well, if you find a good deal, what's the next step, right? A deal doesn't buy itself. You need to be able to raise the debt and you need to be able to raise the equity. And in order to do so, you need to be able to structure the deal in an optimal way, because in the kind of the start of the second book, I talk about how there's 3 pillars to a good deal. You have price, that's pretty straightforward, right? Buy the deal for the right price. Then number 2 is the structure, and then number 3 is the management. So structure is a huge component to the deal, because you could buy at the right price and you could have the right goals, but if you don't structure the deal right, it could be in disalignment with your goals and it could end up not being a good deal, right? So structure is really important, and I think it's also fun to nerd out on the different ways to put a deal together from a debt and equity perspective, because that's kind of where we can get a bit creative on the real estate acquisition side of things. So the second book being all about structuring and raising debt and equity, as I said, is a sequel to the underwriting, because it is kind of that next step after you have basic underwriting done on a deal. And another thing that was a benefit of the second book is it's still a niche topic. We're not going to be on the New York Times bestseller list talking about structuring and raising debt and equity for real estate, but it's a little bit more of a broader topic, because the first book was super niche. It was just about multifamily underwriting, and that is, how many people want to read about that, right? Even people in multifamily don't want to read about that. But thankfully and miraculously, that book has been a tremendous seller and has done a lot for our business to grow our brand, build credibility, build new relationships. So I'm extremely thankful for the success of the first book. And so I was really excited and anticipated the release of the second book, because it is a bit more of a broader topic. The concepts in the book apply to all real estate, not just multifamily. And more people are interested in structuring debt and particularly raising equity than they are multifamily underwriting. So long story short, the second book has been selling, I think, at a pace double the pace of the first book.
So how many books have you sold on the first one? And then how many books have you sold on the second one? Are you aware of that? And then maybe collectively, what do those numbers look like?
So the first book, it has been out for over 3 years now. And we've sold around 12,500 copies, we'll say. And the second book, as you mentioned, and kind of what we're talking about on the show, is it's the year anniversary of the second book, and it sold 7,500 copies.
Well, that's crazy, because if I'm not mistaken, I feel as if like a year ago, the first book maybe sold like 5,000 copies.
Yeah.
So you've essentially done 7,000 copies roughly of both books in the last year's time.
4x.
Which, yeah, so exactly, the talking about hockey sticking and everything like that, the compounding nature, that is remarkable to think about the growth, and nothing is linear in life, as we've discussed many times. So it is absolutely wild to see that growth. And I guess on your end, were you anticipating that at all? Did you think that was a potential outcome of this book, or did you just write it because you thought it was, there was a gap in the market, you needed to place it there? Maybe walk us through that process and that thought.
The first book was definitely more of an organic situation where I felt there was a gap in the market. Nobody was talking about this, and it's such a crucial component of the business. So I thought it was a super awesome niche to fill. And I didn't really have ambitions of selling a certain amount of copies or anything like that. But once I saw the success of the first book, I thought with the second book, okay, now I kind of have a little taste of it, and I want to actually put in the conscious effort to make this thing do well. And it has done well, and it has done better than the first book. And also, it was a whole lot smoother of a process doing something for the second time. Editing, publishing, getting the cover design, and so on. All that was kind of, much more straightforward and streamlined. And then actually the promotion and the launch of the book has been a lot more streamlined because we kind of know the drill. We know what works. Being a guest on other people's podcasts and then plugging the book, that does really well to attract more people and get more sales. So yeah, the second book is doing better, and because of the second book's success, it's helping the first book sell more. So it goes to your point about nonlinear growth. Things compound on each other.
Right. And it's kind of funny because you don't strike me as someone, like I know you really well, I don't think you want to get famous. Like I don't think that's really your goal. I do think inevitably at the course and the route you're going on, you're going to get niche famous. If not, you are already currently. For instance, if we go to all these events, people run up to you and will really, really want to talk to you and will bark your ear off and really give you an ear beating sometimes. And it's flattering. Obviously, I think sometimes I realize very quickly why you wouldn't want to be famous because I just don't think you'd want that attention in that regard. Or you're not an introvert necessarily, but you're not a huge extrovert either. So I think you're pretty in the middle on those spectrums, which is interesting. But how often do you get recognized now for your book? Because if I'm not mistaken, when you were with Zane in New York about a week ago, someone came up to you, and then also we've walked through, New York, and there's people that look at you, and I mean, you maybe don't notice, but I notice that they're staring at you, probably from LinkedIn posting or your book or whatever it may be. But at this point, that has to be pretty regular. So on your end, how often are people kind of recognizing you from your thought leadership, would you say, and from maybe just the two books and then the general LinkedIn atmosphere you've created?
Yeah, to your point, definitely. I think getting broadly famous is just the worst of both worlds. Because if you're broadly famous, then you have all the negatives of being well known, which are well understood, but then you also haven't cultivated kind of a thought leadership platform or an authority platform where you can actually utilize it to make money. And so it's one thing if you're going to be Justin Bieber level famous, but then have the money that comes with it, okay, fine, you can make that decision. But if you're just broadly famous and don't have the money, then it's horrible.
If famous just be famous, but you can't really necessarily monetize it, is what you're saying.
Yeah, and so the sweet spot, like you said, is the niche fame. Which,
Hunter Thompson is niche famous as an example, right?
Yeah, and a lot of people listening don't even know who he is, I'm sure, which is great for him, right?
Yeah.
Because he's making all the money that he should be making.
But in his world, it's the perfect level of it because people will do whatever they can to partner up with him, to work with him, and to be part of his ecosystem. So
totally.
Yeah.
So yeah, that niche fame and just calling it fame almost erodes or undervalues what we're really talking about, because we're not just saying famous like, oh my gosh, there's that guy. It's actually when you walk into a room, your reputation precedes you, and that your investors, your lenders, your partners, your employees respect you. You have a great reputation for being just an honest person, good person. People want to do business with you, right? That makes your life so much easier, not harder, right? And so that's the goal that we want, and why we promote ourselves through books and social media and now the podcast and things like that. So going back to your question, I'd say about once a month I'm getting stopped on the street or somebody says, hey, I read your book, I really appreciate it, and all that. So that feels good, right? Who's not gonna...
It's just enough to give you a nice ego boost, but not too big to inflate your head, right? So,
yeah, exactly. Yeah. So that's super cool, and I think it's we're on the right track.
Yeah. Well, in addition, I was talking to Teddy yesterday. I don't know if he told you this or not, but he had someone who's really good friends that lives in the East Coast now, someone that he's connected with. It's like, oh, wait, you know him. I've read both of his books, and he's like doing graduate school at Columbia, which is really cool. So I think the other interesting thing is I think a lot of individuals whom are consuming and have read and bought your book are likely probably below 40. I don't know if you know the demographics on that, but if it's below 40, that's really good because things do compound. So imagine when these people are, maybe raising capital, maybe looking to deploy, money in all investments like this, or 1031 exchanging, or starting to create their wealth. Hopefully we become the recipient of the equity or the partnership or just the awareness where we can in fact monetize that. So starting young and doing stuff like this, creating this podcast, which we hope to get to the point where like Joe Rogan and it's episode 2000 or whatever it may be. I mean, that's probably not realistic, but episode 300 to 400, and we can, not do direct ads like the All In podcast, but people want to work with us, people want to invest with us by the, thoughts we put in here and the amount of time, the know, like, trust that occurs from, kind of chipping away and being consistent with creating content and thought leadership, to your point.
Yeah, absolutely. Also funny, last week in Houston at the conference that I spoke at, I was talking with somebody and we were just getting to know each other, and I said, oh, well, I wrote this book, and they said, oh, no, wait, let me see, and they pull up their Amazon, they type it in, that pulls up, the book comes up, and then someone who's kind of in an adjacent conversation sees the book on the phone and goes, oh, that book? Oh, I've read that book. That's you that wrote it? And it's funny because it's one thing for people to find out about the individual and then read their book. Because the way that we think about that is the marketing funnel. And this is actually a topic that I think would be very valuable for some people that are interested in marketing and businesses similar to ours, to actually kind of have a whole segment where we talk about the whole marketing structure, landscape, strategy. But just a quick snippet as far as the marketing funnel, when you first get introduced to somebody or a brand, you're probably not willing to invest any money or time into it. So you need a quick, something very digestible and high value. And then after you get to know a brand and you build a little more interest, then you maybe would be willing to read an article that takes you 10 minutes to read, or listen to a podcast or a clip of a podcast that takes 15 minutes to an hour, or read a book that takes you a couple hours. And so we think about that as the marketing funnel. And we want to make sure that we can give people what they want at every stage. If someone wants a 2-second thing, if they want a 5-minute thing, if they want $50 of value, if they're willing to pay for some value, right? It's all the funnel to build a relationship so that we can have lifelong investors. Well, when you take it away from that marketing funnel and you just think about somebody who just doesn't even know who I am and just reads the book for the content's sake, that's a completely different way to think about the marketing funnel. It's really interesting because it can potentially short circuit the funnel. And our friend Richard Wilson has said this many times, and I remember him saying this years ago, where you'll have somebody who goes through every step of your marketing funnel, gets to know you, gets on your email list, reads your book, takes their time, vets a couple deals, then 5 years later finally makes their first investment with you.
And there's some people who I speak with on the phone and they give us $250,000 and they drop off checks in the office right away.
Exactly. So you never know where people are going to hit in the funnel, but you got to have every step of the way.
Well, that's crazy because thinking about that every step of the way, because in 3 years from now, how much of like the tail from what you've created now really could last multiple decades, which is the beauty of creating, because call it what you want. A book is a form of art. So this is the beauty of creating great art, whether you are Jay-Z or, whatever the artist is. There's songs 20 years ago from like The Blueprint, whenever that album came out. I don't know if that's exactly 20 years ago, but you know what I mean? One of those albums that he could sell out Madison Square Garden from the work that he did, the art that he did then. So similarly, it's a crazy and a profound thought. Or Vincent van Gogh having a museum full of art people still go to. If you create really great art or content or whatever it may be, it can last incredibly long. And a book like this, your name is out there forever now, which is so awesome. So that's something, the beauty you get from creating and being an artist in that regard.
Yeah. That sounds good. Well, anything else that we should touch on as far as the book? We didn't really dive into the
I guess, exactly. So going back into it, crazy, we got on a tangent, but what were kind of some of your retrospective thoughts, and would you write anything differently? Is there anything that feels more true in a shifting real estate market now than ever that you touched on in the book?
So the book was published in September of 2022, and the markets were already shifting at that time. The market peaked, and then rates had already been moving up quite a bit, and people were now aware. They were waking up to the concept that rates were not going to stay low forever.
So maybe floating rate debt is not the best idea at the moment. Yeah.
At the time, it was starting to become apparent, and the whole bridge loan game and over-levering deals was starting to unravel. It was very early. So I would say my commentary in the book was fairly even keel and saying, well, hey, there's bridge loans, there's floating rate, there's fixed rates, and you can use them for different circumstances, and that's all still true. But what's interesting is where we are today in September of 2023, it's not very much of an even keel environment. It
kind of one way only, really.
Yeah, people are pretty much only doing deals with bridge loans. People are very fearful of floating rate debt. It's just a crazy market, and I know we've maybe been a little bit of a broken record on this show, but I think it's okay because it's better to be a broken record about this topic and get it right than
it's the
than
flavor.
get it wrong.
It's the flavor of H2, frankly, is what it is. It may carry into H1 of 2024 as well, but these are important things, and this is also kind of a PSA and education for those whom we don't want anyone to lose money because that hurts our business ultimately. If people do, in fact, become snake bit and gun shy because that's a capital call they may have to meet as opposed to giving us equity, which has happened recently with one of investors. Unfortunately, they have a good relationship with a sponsor, and they feel because they've done so well on full cycle in so many deals that they feel kind of a moral responsibility to help them out, which is awesome. We would want to have investors that, if God forbid we were in a situation there, that would want to kind of go up to bat and help us out there.
Well,
so
do you want to explain that a little bit more as far as, because this is something that I was actually talking to a couple guys that reached out to me asking for some advice. They're newer, they just started their business, and we were just having a good conversation. And I think people always underestimate how hard it is to raise money, no matter what environment you're in, because the idea of it is like, well, I have a good deal, I pitch it, people want to get a good return on their money, they'll invest. Actually raising money is so hard, it's so much responsibility, and so it's fine, right? You get a wake-up call, you realize, wow, this is really hard, and you level up and you step your game up. However, it's going to get even harder. And it already has. People already have been talking about it.
It's not easy right now.
It's not easy right now,
No.
for sure. And it's less profitable, which is another whole topic. But it's much harder right now, and I think it's just getting started. And I think people are totally underestimating how much that door is going to close. And I think what you just explained briefly is one insight as to why it's going to be so hard to raise.
Yeah, so essentially the principle is this. When a deal needs to basically get cash and refinance because there is higher debt than the income the property is producing, there needs to be likely a capital call to restructure the deal's debt on the deal's debt. So essentially what will happen is if you invested a certain amount of money, it could be, hey, we need every investor to, let's say if you invested $100,000, we need everyone to come up with, every LP, proportionally speaking, $20,000 into the deal to give it a capital infusion so we can extend this deal and live to make it through, and for us to not give the property back, or for us to sell it and you give us $20,000 now instead of on that $100,000 we're going to give you $50,000 to $70,000 back. So essentially there are a lot of investors out there right now whom are going to want to help people that they've gone full cycle with. Maybe they've been investing in this space since 2015 and they kind of ran the market up with those sponsors, and they feel as if, hey, I want to stick it out through the thick and the thin, which is very noble of them, and it's great that we have investors like that because it's also a mirror of what we might receive in the future if we're in a bad situation. But there's going to be a lot of equity partners who don't want to put their money into the market, into new deals, despite how good the deal may look, or the fact that historically speaking, we all know that times like this actually create the best markets for investments. It's something that they're just going to feel, equity constrained. So they're going to feel really tight in their process of wanting to deploy money. In addition to that, if the deal doesn't feel like a unicorn, what we're going to see is people just not wanting to invest. We have an incredible deal that we're raising for right now that people are struggling to give their money to because the IRR with the internal rate of return, which is the metric that we look at, we want to be more competitive in the stock market, essentially is kind of one of the things, and then also the treasury bills because that's a pretty good yield for a risk-free return right now. I we're doing really well in our raises, all things being considered. I'm very fortunate of that, and we're very fortunate of that, the firm is. But a lot of people are just not used to seeing the new numbers and of what deals should actually look like with debt being where it is right now, with leverage being lower, because leverage exaggerates returns, of course. But it's challenging because there are people who would like to invest their $100,000 a year every single year, whatever it may be, just to diversify. Maybe they put in X amount in the stock market and deals like this, and maybe pay down or put money in a retirement account. What they're doing right now is saving that money for the rainy day that will likely come. And not everyone is reporting the best, or maybe reporting is really slow for reasons. And with rates trickling back up again, I think 7-year Treasury bumped up 11 bips today or yesterday, which is not good. So there's a lot of people who are kind of preemptively, even mentally in the back of their head, realizing that, hey, that instead of giving $50,000 for this new deal, I'm going to save this just in case so my equity is not diluted, and maybe this saves the deal from getting taken over from the bank.
Yeah, and certainly, like you're saying, kind of the honorable or moral capital call where, hey, I want to help this sponsor out, which I'm an LP in a deal that got capital called, and economically speaking and structurally speaking, the way that the deal is structured, I really shouldn't have made that capital call.
Yeah. So how did that feel when you did it? Like, is it like, I know this is like illogical, not rational, but I have a heart. Like, and because sometimes investments are we want to all be unemotional with these things. We don't want to act like we're heartless investors and we're just stone cold. But at the same time, we do really value people. This is a people business at the end of the day. We hope to be the best people you could possibly work with and the most likable people. But did it feel like this is not logical, but I want to do it just to help this individual? Why did you do it? And I guess what was the emotion on your end going through it?
Yeah, it wasn't a big sum of money, but it was the irrational thing, you could say, or the illogical thing, not the right strategic move. But as a friend to the sponsor, why am I going to be difficult here? And I just made the call. So there's going to be, like you said, there was that instance of a similar instance, but most of the time people are going to not do that. And they're going to only make a capital call if it behooves them. If they are scared to lose their initial investment and they think that it is going to require this capital call to protect their original investment, then they'll do it. Or because all capital calls are written differently in the docs, some capital calls are dilutive and there's a penalty. So if you don't meet the call, you can actually get diluted at a penalty rate. Otherwise, if you don't meet the call in a normal circumstance, then you just get diluted on a pro rata basis. There's no penalty, no big deal. And in that case, it's like, well, why would you put good money after bad if you're not going to be diluted at a penalty rate?
Well, also, you got to figure, it's like if there's pain in the market as well. Why am I putting my money in a deal that's already in pain? Why won't I try to find the screaming hot deal from someone who's distressed that actually needs to sell, who's didn't figure out the money to raise, where it's like, oh my God, I'm getting this at 80 cents on the dollar or 70 cents on the dollar, whatever it may be. That's a tough kind of predicament to be in, because you could theoretically find an awesome opportunity if you elected to put your equity elsewhere.
Well, that's exactly right. And that goes back to our fundamental issue that the reality of markets, no matter if you're in real estate or stocks or anything else, is the best deals are when there's no money, and when there's a lot of money, there's not very many good deals. That's just a fact of life. And in our business, when we're talking about raising capital, when the deals are going to be the juiciest, it's going to be the hardest to raise capital. And that is a fact, right? It's not an opinion, because when it is hardest to raise money, that means there's the least amount of liquidity in the market, which means deals have to get discounted enough. So for that, the limited amount of liquidity that there is in the market, that capital is willing to buy those properties and pay that price, and which in exchange they get a higher expected return. So I think that's maybe a little bit of a silver lining or a bit of a pep talk that, hey, if it is hard right now or it's going to get harder, just know that the deals you're doing are going to make you wealthier in the future, because those are going to be good deals.
You're going to learn as well, so you'll learn how to navigate through this time. And if you can make it through this time, you can make it through any time. So this is really when sponsors get battle tested, their battle scars, and when they earn the fees and kind of go through it and create the iron chin to make sure that they can get through everything, because people are getting punched in the mouth right now. It's funny, on the phone, I thought I had on our end a $250,000 investor that wanted to come in, and then he actually just let me know, I can't because I'm concerned about my other deals and I need to stay pat, which sucks. So I just received the information today. I was like very certain he loves the opportunity, but unfortunately, he has other obligations he has to meet. So, and that's just probably the start of a lot of that. And also what hasn't really started to happen yet, but I think will start occurring, is job market could get worse. So if job market gets worse, okay, well, instead of the $50,000 that I want to put into this real estate deal from an investment perspective, hey, I might need to use that because I might not find, if I get laid off, I need, maybe get some severance, but it may not take me 6 months or 3 months to find a good job that I like. That $50,000 needs to support my lifestyle and bridge me to, a greener pasture and a better market from a job perspective. So things are just going to get tight soon. Money is going to get tight. People are going to start auditing their bills more. People are going to start looking at their finances more. I don't know about you and how you're living, but I personally have kind of changed my spending habits a bit. Not too much, obviously, because I've just bought myself some new sunglasses, but it does make you think and want to be tight on where your spending is. I mean, these are pre-recessionary, maybe current in the middle of the recession times we're in right now. So it's just things are going to change.
Yep.
Yeah.
So I think that kind of ties in. Maybe we're going on tangents today, but
yeah.
I think it's okay. They're interesting. But as far as tying it back to the book, I didn't really have all this recession talk in the book and stuff, which is fine. I did talk about certain conservative metrics and downside protection, all that, which is valuable today. But what is going to be really interesting coming up, and I was actually talking with our debt broker, Nate, today, who's actually, let's give a quick shout out to Nate Lowy, because Juniper Capital Group, his firm, is sponsoring. They're the platinum sponsor for our summit coming up in New York. So
got great Mets tickets too if you do business with them. Yeah, great Mets tickets.
Great.
That unfortunately I couldn't use, but I guess that's the handicap that I get from not being in
remote
New York.
employee.
Exactly. Yeah.
So Nate and I were talking this morning actually while I was on the plane about what's going to happen. How are we going to be able to finance deals when we're in a tumultuous market? And he had some creative strategies, which we'll kind of keep close to the vest, keep it under our hat, and
only our investors, our JV partners, capital raising partners, fund managers who work with us exclusively get that information. So if you want to work with us, my email is craig@lscre.com. Okay, final email plug.
You know what's funny is Kent came into my office, I think yesterday or the other day, and said, "Hey, I listened to the podcast. It was good. Brad did well. Everything's good." I said, "Yeah, good. Brad was awesome." And he said, one piece of advice for Craig, he really promotes a lot. And I said, well, yeah, that's the point, right? Like Craig's the promoter. He's the shameless plug.
Yes.
I think that's great. I mean, we'd love to hear from everyone in the comments if they like it. But we know Kent, but nobody knows Kent because that's by design. Which actually, in another episode, I'd like to talk about Kent and our partnership, how we met, and kind of our dynamic and
Maybe
stuff.
we can have him on the show. We can blur his face out the entire time and have a voice mute, so we can keep his him anonymous. Not that they couldn't go to our website and figure out what he looks like. But.
Well, I remember when you were in New York, you asked Ken. He said, "Oh, so you're gonna be on our podcast, right?" And he said, "I don't think so."
Yeah, he basically is backpedaling when I said that. He regrets maybe walking in the room.
He would just exactly walk
he
right out
leans
of the
back.
room.
Yeah.
So anyway, obviously all this promotion and publicity is not Ken's style, but all in all, he's enjoying the podcast, so that's good. But going back to the Nate thing, we'll keep some of the strategies private, but yeah, it's going to be a big learning experience to learn how to finance deals when there's going to be limited credit in the market, because we don't know what the capital markets are going to look like, but certainly one would have to imagine that spreads are going to blow out, which means rates are going to get even higher, aside from the Fed raising them or the 10-year going up. But if lender spreads, which is the lender premium that they charge, if those go up, then that increases your interest rate. And then also in a downside scenario or in a recession, lenders, just like investors, are more fearful. Lenders are going to have issues. They're going to have foreclosures. They're going to have losses on their books. So lenders are going to be beaten up and less optimistic. So what are they going to do? They're going to tighten up on their underwriting standards, and they're going to be denying to quote loans. They're going to be holding deals to a higher standard, so they'll lend at a lower leverage point. So all those things are just going to hurt your ability to buy deals, because so much of a deal hinges on the debt. So it's funny because Hunter, our good friend that you mentioned earlier, asked me to speak at an upcoming event, and he wants the title of my presentation to be Structuring and Raising Debt and Equity in a Recession. And that's not the title of my book. We didn't really go into it, and I'm excited to go through it because I'm going to learn a ton, right?
Yeah.
We haven't been through a true recession. People who are claiming that the COVID period was a recession.
That was a blip. That was a small wrinkle.
That was a quarter, maybe two, and then the unlimited money printer went on and everything. So it was an interesting time for sure, and an educational time, but this is going to be the real deal. And for all the investors that say, hey, I only invest with cycle-tested or recession-tested sponsors, this is the one. This is finally going to be the opportunity.
I am very excited for many reasons, because when we get to the other side of this, I mean, the way our portfolio is expanding, it just sounds cool because we're in the process of hopefully, crossing or getting really close to, hopefully at this point next year, we'll be over.
Where's wood?
There's wood all over. I think that's real wood, KK. We'll be over hopefully at this point next year, well over $500 million of assets under management, which would be incredible. But to grow that and then, of course, selfishly flip that whole portfolio into a market that'll be kind of hockey sticking up again, and kind of transitioning in there will be really cool. But then we'll be more recession tested, and our track record should ideally really start to look a lot more positive, not just oh wow, yeah, you bought a couple of deals in 2019 and you sold them in 2021. You must be a real estate genius. Congratulations. So, of course, not everyone can do it, but basically anyone who is not and it was a lot easier. The game was not as difficult or challenging, but now if you can create mid-teens returns in this time, that's when you really start making a name for yourself. So I'm extremely excited for that. But it's funny, back to structuring and raising equity for deals. We spoke about this before recently, and I think we mentioned this many times, but kind of our sweet spot right now, and we're kind of in a raise that's well over this number, but we probably feel comfortable raising somewhere between the $8 to $15 million range for equity, which can buy us a deal right now that's in that kind of $20 to $35 million range, comfortably speaking, around that, close to it. But we were talking about this on the phone last night, or maybe 2 nights ago, how, wow, raising $10 million 2 years ago, what you could buy a $40 million deal, and now leverage is cut in half, literally leverage is in half on that. So it's just nuts how much interest rates really do drive the market, and how timing is very crucial. But we want to make good timing on every single acquisition and be very disciplined throughout by implementing the thoughts in your book and making sure we structure and raise debt and equity correctly. With that said, I do have a couple questions for you that follow up on this, believe it or not. But what is something that you'd never do now that you learned from the structuring perspective that happened over time? I mean, is there some things that you thought would be a good idea that you realized, oh, heck no, I wouldn't want to do that? Like, for instance, I don't think you want to do floating rate debt anymore. So that's a structure question.
Yeah. I was going to pick floating rates as a topic because rationally speaking, and if you follow the numbers, floating rate debt, historically speaking, has outperformed fixed rate debt. Floating rate debt offers more prepayment flexibility, so you can take advantage of a rising market and you can sell for a minimum penalty. And then also, just if you look at the data over time, when you float, you end up paying less interest than if you were to fix. And that is true over all these different slices of time. However, as we've seen in recent memory, floating rates have been wrong in a big way and very painful. So that flies in the face of the data. But even if this didn't happen and the data was infallible, I have changed my opinion on floating rates because we aren't in a rational business. We're not just cranking out numbers and here you go, have a nice day, right? And you've heard me say this a lot, and I hope other people have heard us say this a lot. We're in the business of helping our investors sleep well at night. And floating rates make it harder to sleep well. You might end up with a higher return, maybe. Unfortunately, recently that's not true, but you certainly will not sleep as well. And fixed rates take interest rate risk, at least on a cash flow basis, off the table. And as we know, cash flow is really important to investors, and it's a gauge of health for the project, and it really does smooth things over, right? If there's hiccups in the market, challenges in the deal, but if you're still cash flowing and you're able to deliver monthly distributions to investors, that smooths a lot of things over. So with all that being said, I think that in spite of the data and the compelling reasons as to why you may want to float, I really feel very strongly about having a fixed rate long-term debt strategy because it really does help with eliminating variability and helping investors sleep well at night.
Okay. Awesome. And then what about from an equity perspective? It's kind of funny. A lot of people ask this, and this is the hot right now. It's like, oh, are you interested in pref? And the answer is no, and we've never taken pref in a deal before, I'll have you know, which is definitely a flex. With that said, is there anything from an equity perspective that you wouldn't take that has changed over time? Or are you pretty adamant, just, we look to avoid pref if needed? I guess maybe walk us through that as well, and maybe anything that would be helpful for any newer sponsors, anyone looking to kind of figure out the game and the business. If you could share any insights while we're on the topic before we transition to the next subject, that'd be great.
Absolutely, yeah. I always find it funny when we tell somebody, oh, we have XYZ family office, or we partner with this private equity firm, and they say, oh, what were the terms of that pref? I say, no. It's not pref.
Common equity.
It's pari passu. It's JV equity. It's common equity. So yes, not to say that we will never do preferred equity, meaning borrow preferred equity. We haven't yet, like you said. And I think we've been fortunate to learn early on how we like to structure deals from an equity perspective. And the reason why we learned that early on is because we've been fortunate to partner with institutional, quasi-institutional partners from very early days. From our second deal, third deal, we already had those institutional partners, so we were getting that experience and we were being shown, okay, this is how the big boys structure deals. So I don't want to say less sophisticated, but more retail deals and sponsors have cash flow promotes instead of an IRR-based preferred return. And there's other maybe small wrinkles in there as well, but that's kind of a big one. That's a delineating factor between institutional deals and non. So we latched on to the institutional stuff and just have stuck with it. So I think our deal structure is good. I don't really regret anything. The point I do want to mention, since you did bring up pref, is let's actually talk about why we have never borrowed pref. Because some people might not know why, right? I'm sure savvy listeners go, okay, well, yeah, pref is usually not the way to go. So what preferred equity is it's equity, but it kind of is like debt, where the preferred equity gets paid before the rest of the equity, and so they have that downside protection because they have the equity cushion of the other equity in the deal. So they get paid first on cash flow. Upon a sale, they're the first money to get paid back after the lender. So they're in a preferred position. And they also charge what could be, let's say, 13, 14, 15% returns in that debt-like position. So now you're sitting there kind of paying out equity returns to someone who's subordinating you. So you're taking on more risk and paying a lot to take on that risk. So it can be an unfavorable circumstance unless you have such high prospective returns on your common equity that it's worth it to pay that 14% because you think that the deal's a 30%.
And then you get the spread above that.
And then you make even more because you're leveraging yourself further. So that's why we have never done pref, because it usually puts you in a bad risk-adjusted return situation.
Yeah, a ton of upside, but your downside is not mitigated at all.
Yeah, I mean, it's just like regular leverage, right? Which exacerbates returns in either direction, good or bad. But what's going to be very interesting is, I think, in the next year, like we keep talking about, there's going to be opportunities in the market. There's going to be blood in the streets, and there's going to be deals at a discount. I think that is going to be the time where we may actually do pref.
Strategic pref, yeah.
It might be the
time.
I
think about that all the time is, hey, and also just another thing that's interesting too, if you are a prospective sponsor, you do have basically to disclose and let every investor know that your equity is not, common equity, not pari passu. Pari passu means shoulder to shoulder, by the way. So basically everyone's equity is treated the same, not in a preferred position where the pref holders get paid first and then you, the LP investor, just for clarity on that one. Mm-hmm. But with that said, it is going to be very interesting to see when that would look like, what it would look like, but you need to disclose that. And the capital stack, one of the questions we ask is, how much pref's in your deal? It's like, none. and it is people will actually give you a second look based upon that, and will look at it a lot more deeply. And it's not that there's any shame in taking pref, but there's definitely a certain gravitas and level associated with groups who don't need to take that for sure. So it's definitely a point of pride I think that we've had and being able to maintain. But there may be some deals that if there's a screamer and we feel good about it and we get reasonable prep terms from maybe a group who likes us and trusts us, and we can kind of beat them up a bit on fees, and we love where the deal looks, that we might just say screw it, let's just go in on that and make it easy for ourselves, and raise on a different deal and acquire something else.
Yeah, we'll see what the market looks like, and maybe it doesn't come to pass, but it just could be a situation where it actually does make sense because projected returns are so high that you don't mind paying the 14-15% for the pref partner because you think you're going to make a 25.
Right.
So we'll see. It's kind of just maybe a little early prediction or some thoughts that I'm having. But so that's some structuring debt and equity commentary.
Yes. Well, very long 45-minute retrospective, but it did deserve that amount of time. And we were trying to get to this for the last two podcasts. There's a reason, obviously, as to why we couldn't get to it yet, because this was very nutrient dense in that regard. Next subject is Texas trip recap, broker talk update, San Antonio and Houston updates. How was the trip last week with Brad?
It was very good. Yep, we were in Texas.
Lots of vegetables, really clean eating. I'm sure didn't eat any meat, vegan diet, right?
There was not a vegetable in sight, unfortunately. I got back home and all I had was salads for a few days.
Yeah, so it's funny, you do crave salads when you're on the road like that, and then eating clean, and also maybe going to make, I don't know, you don't make food yourself, but every time I get back from a trip, I just love making food myself, knowing exactly what to put in my body, so especially recently.
Very good.
Yeah.
Yeah, no, it was a good trip. We met with a lot of brokers, so we had a lot of tours, sit downs. I mean, we covered a lot of this on the last show, but it's just interesting to hear because brokers are kind of in the middle of the market and they know everything. They're talking to every owner, they're talking to buyers, they're talking to sellers, so they know exactly what's going on. Other brokers. They're talking to other brokers, so they're a great wealth of information, and they're echoing, every broker that we met with, we're essentially echoing kind of the sentiments that we're having, and that we're in the early innings of what is going to be a recession, and there's going to be opportunity. So yeah, I feel like we're belaboring that point, but that is kind of the recap. San Antonio is a new market for us, so we spent quite a bit of time in San Antonio just seeing a ton of deals, meeting with every broker and picking their brain. And just one thing I really like is, this is totally taking a step back, but one of the things that really served me well when I was starting the business is I was willing to ask questions that might make me look stupid. Right? I was willing to be humble and say...
You mean you weren't trying to be the smartest guy in the room at every single time?
Exactly.
Well, you don't have some ego complex where you're naturally intelligent, so it's not as if you need to puff your chest with peacock to seem more grandiose, which is a very... back to this, he's actually, believe it or not, a very humble person. So, yeah.
Yeah, so...
His wrist is not very humble, but he's a humble person.
Yes, we can maybe talk about that at
we'll
another
get
time.
into it, don't you worry.
Yeah. So, so that has served me well, asking questions, and that's exactly what we did in San Antonio. Hey, we're new to the market, right? And it's funny because as a buyer, your job is to convince the broker to award you the deal. And you don't get awarded the deal necessarily by paying the highest price or having the best terms. Your reputation matters a lot, and your experience matters. So if you show up to a broker and you start asking all these dumb questions, what's a cap rate? And what's that deal down the street?
There's levels to it, yeah.
Right? I mean, I'm just painting a picture here, but you're kind of, in a way, you could possibly think that you're shooting yourself in the foot as far as coming across as a viable buyer that they should take seriously and that they should send deals to and take your bid seriously. But, we have the luxury, honestly, of having enough of a track record, having enough of a presence in other Texas markets so that when we came to San Antonio, the brokers already knew who we were, and we could be quite honest with them. Hey, we don't own anything here yet, but here's our plan, here's our experience, can you teach us about the market? And people were super open about it, and it was not a problem at all. So I think that was a pretty cool takeaway from the San Antonio part of the trip.
Yeah, and then were you excited when you were there? What was kind of your feel, is your buzz and, kind of your overall feeling now that you left it? Are you excited? Do you want to buy there more? Do you want to stick to Dallas more or Houston? Or do you like the viability of the third marketplace for us to enter within the same state?
San Antonio is a great market. When I was there, I was kind of thinking to myself, oh gosh, why did we decide to enter into another market? It's going to be so much work. Have to fly to another city, rent another car.
And what is interesting on Brad's end too, fly another city, rent another car, boo-hoo. But Brad now has to mentally internalize now, okay, well, here's price per unit, which by the way is not the same in Austin, Dallas, San Antonio, or any market, obviously. Insurance is different, but it is very interesting to think because now he's got to grow his mental repertoire of what something should look like, what a good deal look like, what a deal does not look like, and everything else in between. So we have to really re-educate ourselves on that market. And then on my end, when I go into the pitching process, well, why this submarket? Other than, the school districts or, this, we'll know like what jobs are coming to the area, what are their demographics like? Do people stay here for a while? Is this a good tenant place? Do people want to live here? Are people moving to the other side of the city for XYZ reason? So now we have to get a lot more smart on Texas.
It's a ton more work. Brad has to talk to a ton more brokers. That's more people he has to be on the phone with and stay in touch with, more deals to stay on top of.
It's less time for him to speak with me when I have a silly question regarding the underwriting on a deal. Yeah.
So it's a serious decision, and people who know us know that we are very focused. We don't expand into a market lightly. When we decide to move into a new market, we go and we make it happen. So I was kind of regretting it a little bit because I was just getting overwhelmed by all this and thinking to myself, gosh, we really can just have a lovely business just buying in DFW and Houston. But San Antonio is a lovely market and there's a ton of opportunity there, and it fits our profile really well because I like the workforce housing there a ton. The workforce is really awesome. People are hardworking in San Antonio. They want a clean, safe place to live, and we can do just that, and we can buy those deals at a good basis soon. And I also think San Antonio is not the most complicated market in the world.
Which is good.
And I think
I'd rather expand it. It's like if you're going to have a core market and make it really complex and hard to digest, maybe they make that your main one. But to add with kind of where we're at right now, something that's a little more down the fairway and simplistic kind of sounds nice.
Yeah, and it's a nice balance, and then it also is diversification. Investors do like that we're able to offer them deals in different geographies, and that's helpful too.
Cool. That's the broker talk. That's the update. Do you want to make a kind of a comment as to one, you don't have to say the name of who, but had very high, not expectations, but hopes for us in our ability to acquire deals in 2024. Do you want to share what we said? Okay. No. Very, very ambitious. Yeah. Maybe we'll say that for a teaser for next time. Yeah. Okay. Any other? Yeah. So I guess when you go to a city, how do you view that city? Like, what lens do you see it through? What do you look for? What would say, okay, I don't want to buy in the city for those reasons? I guess. What are some of the green flags and red flags that you'll see when kind of touring through, and I guess your perspective on that? I mean, I know you kind of hit on a bunch of things, but what are things I guess you look for when you go to a new place?
Well, the green and red flags really happen before you get there. At least for me, population growth, the incomes, the supply pipeline, and things like that. Really basic, high-level stuff, jobs and everything. What's the narrative? Because if you don't have that, then it's going to be an uphill battle in every respect. So before we even show up, those boxes are checked, right? And the major markets of Texas are fantastic. All those boxes are checked. Everything's good. So when we're actually on the ground, I'm really more so focused on the micro pocket because I know the overall market's good. And so I'm looking at the sub-market. I'm looking at the competitors to the property itself. What's nearby? Does it... are the roads in good condition? Does it look like a dilapidated area? Is there vacant retail? I want to understand and just see it in person. Are people who look very run down and are homeless walking the streets, or is it people going to work and they look gainfully employed and things like that? Families. So those are the things that I look for when I'm on the ground, actually going from property to property.
Cool. Okay. Any other notes on the Texas trip and broker talk and updates there?
Nope.
Cool. Well, should we get into our newest endeavor? the watch business. So hopefully we'll have your uncle on at some point who's a Patek Philippe specialist, but we are moving forward going to be selling watches. I think it's something that's in brand and true to who you are. I just love selling anything, generally speaking, and I've always kind of liked watches as well. And by proxy, being friends with you, it's going to rub off on me. So yeah, we're going to start selling watches. So if you are ever looking for any specific piece, I guess maybe you can kind of go through and share your vision for this and our capabilities of how we can procure certain pieces. I think we could probably literally get anything under the sun for the most part, but why don't you kind of dive into that?
Yeah, absolutely. So my uncle, who I think we've talked about a little bit about on the show before.
We're bringing him on, by the way. Language barrier will be just. I think that'll actually be a little flavor for the show.
It'll be really cool. It'll be super cool. So my uncle has actually been in the watch business for 40 years, and really specialized in Patek for 25. So he really knows what he's doing. Really special to have that person on your team and that relationship. And me, you, Kent, we're all really into watches, and I think it's just a natural extension that if we're having this as a hobby, enjoying it, talking about it, we might as well make it a little bit of a business.
Let's monetize it, yeah.
Well, monetize is a bit of a strong word because, frankly, I don't think we're going to make any money.
It's a hobby. It's a hobby, yeah.
It's a hobby.
Well, hopefully we'll break even and have a couple of pieces we can wear for free, basically by association of just selling some pieces.
It could happen. It could happen. But I think my biggest goal is to sell watches for the absolute best price to our friends.
Yeah.
And so we've already done that, which we'll talk about shortly.
Yes.
And we've got some more pieces in the works. But basically, if you're one of our close friends or investors or anything like that, we would love to work and find you.
Or viewer of the show.
Well, if you're a listener, if you're a loyal listener, we can maybe consider doing business with you as well.
Right.
I think my uncle, I had a long conversation with him the other day, and he said, in his business, he has no interest in dealing with someone who he doesn't already know. Right? He's not at that stage of his life where he's looking to sell 1 million watches.
Doesn't need to hustle anymore like that. Yeah.
Yeah, he only does business with people he knows and trusts. Because the watch business, there's a lot of trust, and I think that's actually kind of a nice extension of what we're doing here. And if people know us, then hopefully they like and trust us, and that makes doing business with us a lot easier. Like, for example, when I asked Zach last night for the wire for the watch,
I think 2 seconds later, he sent it.
And, frankly, he's never met me, but we're already good friends through you.
Yeah,
right?
and he's one of my best friends in Arizona for sure, and I've known him for I've actually known him for a decade now, so I knew you'd come through. Yeah.
Yeah. So
there was not a sliver of doubt.
Well, and I was willing to put up the money. So I had never met. Hold on.
Yeah. Right.
I never met Zach, but I was willing to put up my own money to procure the watch.
Yeah.
And then who knows? Maybe he maybe he changed his mind, doesn't want to buy it.
Well, if he did, I guess that would end up at my
Correct. I mean, it's a very good price.
Yeah.
So,
right.
I mean, it's not a sad thing to be putting up the money for it, but the trust is two-way. So in the watch business, like in any business, there's a ton of trust because there's fraud on the money side. The money could disappear. The watch could disappear. The watch could be fake. There's a lot of trust involved. So the fact that I have family, and then through me, there's an extension of trust and whatnot. So that's really exciting. And so I think that's something that will be kind of, since we're talking about watches on the show a decent amount. I think people that are listening may be interested in joining, reaching out, having an interest. Hey, I'm interested in this piece. Can you find it? What's the pricing and things like that? And we might want to jump on that assignment and work with you on that. I think that's kind of a good introduction.
Yeah, absolutely. And we want to guarantee, basically, we will use a G word here, but guaranteed authenticity of the piece, and also know that you're getting competitive pricing. You can go on Chrono or Bob's Watches, but there's just a level, it's not a weird process, but it's not easy. And obviously, good luck getting a nice steel watch that's a sport watch, whether it be a GMT, a Submariner, or a Daytona for retail. With that said, I want you to bring up Zach Wiles' piece right here. This is a beautiful and timeless piece, probably a little bit above a starter watch, but this is his first Rolex. Why don't you break down, do you have the reference number? Do you know it offhand?
Well, I'm not that big of a nerd. I know Patek references, not Rolex references.
Right.
But here we have a what is this? A 116710 BLNR, or better known as the Batman. And for those that really know watches, they noticed that I said 116 and not 126 because this is the older model that's discontinued. So this is a brand new 2017 piece. So that's really exciting because it's very difficult.
You want to show the box and papers that come with it and the card as well?
Yeah, so this is the papers, which is not really a paper, it's actually a Rolex card. But this is the card there, with authenticity. There's some other papers and stuff that Zach's going to read through it, very seriously. So this is a discontinued Batman, and according to my uncle, again, I'm no watch expert, but according to my uncle, who is a watch expert, he says that the discontinued Batman is really the special one, really the one to have, and so it's very rare to actually have this piece that's from 2017 in unworn, brand new condition, right? Because it's 2017, it's 6 years old, so there's just fewer and fewer of these that are sitting around unworn. And I do think that there's nothing wrong with buying a used watch. Your watch is going to get scratched up anyway, so no big deal. But there is something very special to be the first person to own a piece. So I like that. I think it's worth a little bit of extra money. Not a ton, but if you can get away with paying a little bit more to get a brand new example, I think that's lovely.
Yeah, absolutely. Well, it's a incredible watch. Also, my boy Mitchell Martella DM'd me or sent me a text saying you should get the piece as well because I want to get the Batgirl, which is a Jubilee bracelet. It's just ever so slightly different. But he texted a picture like I have my Batman and he loves it. So shout out to you as well. But funny, beautiful thing. And if you're looking for anything, Daytona's, Pateks. I don't know. Do we even sell APs on this show?
Well, it's funny. You and I aren't huge fans of AP, but
Sorry, Lemelich. Yeah, I apologize.
Yeah. But we could make it happen.
Yeah.
And speaking of Daytona, I am selling my Platinum Daytona.
Okay.
It's official. It's currently being polished and put into brand new, pristine condition. So if anybody listening is interested in buying a Platinum Daytona,
price available upon request.
Yeah, I have no idea what it's worth. I have no idea what we're willing to sell it for, but you're gonna buy it for a lot less than what I paid for it.
Yeah.
And
but you have been dollar cost averaging in your game. So with that said, do you want to show off the latest piece and maybe do you want to tell everyone about your girlfriend?
No. I think we're just gonna do a little tease from far away. You can see this is an Aquanaut. For everyone, they can see it's an Aquanaut, but that's all we're gonna share is for the story.
He's got a girlfriend. Her first initial is T. I'll just leave it at that. Yeah.
Well, now you're gonna make people think that I actually have a girlfriend, which is not a big deal, but. No, my girlfriend is Tiffany, so hopefully that's a big enough hint for watch enthusiasts to know what we're talking about.
Yes, and then finally, now that we're through with watch talk, we had a mailbag question I wanted to get into, which is the following here. Texted it over to you. Just an idea for a topic on the podcast. I'm super curious to know about this, the tax benefits of investing in real estate from the GP and LP perspective. Maybe case studies exactly these benefits are and how they play out, etc. I'm personally super interested in that, and I'm sure many people are as well. So maybe if you could break into the tax benefits that and we're not CPAs, but some of the tax benefits you've experienced. I've certainly experienced a lot last year. I got a hometown sweetheart deal. Thank you to bonus depreciation as a real estate professional, which I am. But why don't you walk it through from both sides of the aisle, sides of the aisle, which is the GP and LP perspective.
Yep. So again, we're not tax professionals and we're not giving tax advice, but there's a ton of tax benefits to be had in the real estate game, both as an LP and as a GP. So we'll start on the more basic side as an LP. So if you're a limited partner investing $100,000, $1 million, $10 million into a deal, you're going to receive your proportionate share of depreciation. So every deal is structured differently and every deal throws off a different amount of depreciation, and those laws are always changing. So last year was the last year of 100% bonus depreciation. Now it's for 2023, 80%, which is still very good. I don't want to get into the weeds as far as what exactly bonus depreciation is, but just know that it's a bonus and it's very good.
Yeah.
So with bonus depreciation, you get a ton of tax benefits the year you buy the property. So you get a lot
accelerated.
Yeah, exactly. Yeah. So bonus depreciation takes 5-year useful life items and 15-year useful life items, and allows you to take the value of those items and depreciate them all in the first year. That would be 100, and now it's 80, so you can take 80% of that and get that in year 1. So you're generating a very large paper loss when you're investing in real estate, and you can use that paper loss or depreciation to offset capital gains and other rental income in your investment portfolio, which is hugely beneficial. But frankly, the average investor is not getting a ton of value out of depreciation, or they're getting a good amount of value, but there's levels, right? Because unfortunately, as an LP, you can't take depreciation and use it to offset ordinary income.
Unless you're a real estate professional, correct?
That's
You could
exactly
be a real
right.
estate professional, or if you're married, have your wife become a real estate professional theoretically, and you could do taxes jointly together to minimize your tax burden, which is everyone's biggest bill.
That's exactly right. So you're giving away too many good secrets, but that's totally right and very, very powerful.
Wife or husband, yeah.
Yes, absolutely.
Yeah. Spouse, partner.
Filing jointly, yeah. So with that in mind, if you're just a dentist, doctor, then you can't use your real estate depreciation to offset your dentist doctor income unless, like you said, your spouse is a real estate professional and you file jointly, then you can.
But what if you are a LP investor and you are a dentist and you invest $100,000? Do you get any gain? Are your distributions tax-free? Is anything come tax-free? How does that work? How does it play? Why do people say I need to invest in real estate that are not real estate professionals for the tax benefits?
Right. So again, you can use the depreciation to offset other real estate income or capital gains in your investment portfolio. So it's still valuable for your investment portfolio, absolutely.
So like you said, so if you were to sell stock, but you had bonus depreciation, so let's say you sold Apple stock, but you had, you sold that and then you invested into a Lone Star Capital deal. You could use the depreciation there in year 1 to offset the Apple shares that you sold off.
That's right.
Okay.
That's right. So, and if we just focus on the deal itself, the distributions associated with the deal, the ongoing cash flow, depending on how long you hold the deal, should be completely sheltered by the depreciation generated by the investment. So your tax liability for the deal you shouldn't have a tax liability until sale, because you should be able to buy the property, utilize depreciation to defer tax. It's not tax-free, it's tax-deferred. We're deferring taxes, right? The best way to play the game of taxes is obviously tax-free, right? Just no taxes, but the other way is to defer them, because further out into the future, that's better than today, and then also shift them from a higher tax level to a lower tax level. And what does that mean? Well, for example, if you can take a tax liability that would be taxed at ordinary income or short-term capital gains, and you can push it off and change it into long-term capital gains, you're reducing the tax rate and you're saving money on taxes. So just to kind of finish that thought, you buy the property, you generate depreciation, you shelter the ongoing income, and then upon sale of the property, you're going to have to recapture the depreciation and you're going to have capital gains. So you're going to have taxes upon sale, and it's going to be on you, the investor, to then find a way to shelter or defer those taxes again by reinvesting the proceeds, and et cetera, et cetera. So that's kind of the basics of the tax benefits associated with being an LP investor.
I really can't sell any of my my investments that I made into Madison at Berry Creek or Park at Champion Forest due to my circumstance for many reasons, which is kind of funny, which we're not going to get into. But that would be a bigger bill on my end.
Well, you just roll it over, and you just have to create more depreciation. And but that's also the benefits of being a GP. And because now we'll shift to the GP side of things, there's also tax benefits associated with being a general partner. And I would say the biggest one is when you can take a disproportionate share as the general partner of the depreciation. So what that means is, and again, I am not giving tax advice, but
experience.
You can take by having a deficit restoration order, I think that's what it's called, which it allows you to have a negative capital account, which means that you can take depreciation in excess of your basis, and your basis can be negative, and that is a powerful way for a GP to get depreciation without investing any money. And that's how a GP can generate a lot of depreciation for his or herself and not pay taxes. So that is the supercharged strategy for a GP to be able to not pay taxes, coupled with the fact that a GP is a real estate professional, so they can utilize the depreciation to offset all forms of income.
Very good. Any other topics on the savings world that can be created from this as a real estate investor and from a tax perspective?
No, my skin's crawling from talking about this because I don't want the IRS to be listening.
Right. Well, with that said, do you have any final thoughts on this episode?
No, I'm all good.
Well, we're going to tear up LA. Let's close it with the sunglasses on, same way we entered it. We are living the LA lifestyle here in West Hollywood. We are very appreciative for those who watch the show, who reach out to us. I think at this point, basically, I swear once a week at least, I get some sort of a messaging or someone saying something to us, so we really do appreciate that. It's funny, we put this content out there. We don't know who's going to listen to it. We don't know who is listening to it, but obviously if you tell us, we do know, so we're very appreciative of that. If you think this show would be a good fit for someone or anyone you know, please share it to them. And then if you listen to this on YouTube or wherever you are, podcast form, if you could just like it, give it a 5-star review if you're on the podcast or whatever. I know we don't ask for that much. We probably need to start doing that more. Sorry, Kent, promotion is going to get worse and worse as time progresses. If you have any questions about the summit event or anything Lone Star related, please reach out to myself, craig@lscre.com or ir@lscre.com. Once again, thank you so much for listening to the show, and we'll catch you next week.